On July 22nd, 2026, Alphabet reported its strongest revenue quarter in 5 years. Google Cloud grew 82%. The company beat every estimate Wall Street had written. And for the first time since its IPO in 2004, Alphabet posted negative free cash flow. Negative $5.9 billion. More money went out than came in. Moderate. The same day, Tesla reported record revenue and record deliveries. Then, investors saw the cash flow statement. Negative $1.1 billion. Capital expenditures had surged 142% in a single year. Both companies beat earnings. Both companies lost money. Both companies told investors to expect more spending next year. These are not startups burning through Series B funding. These are two of the 10 most valuable companies on Earth, and they are not alone. Alphabet, Amazon, Meta, and Microsoft, the 4 hyperscalers, are on track to spend $725 billion on AI infrastructure this year. That is a 77% increase over last year. Analysts are already projecting $1 trillion in 2027. In the next 9 minutes, we're going to follow that $725 billion, where it actually goes, what it actually buys, how long those assets actually last, and why the math underneath this spending cycle looks uncomfortably familiar to anyone who watched the last one. If those numbers surprised you, the structure underneath them is significantly stranger than any earnings headline suggests. Let's start with the invoice. Alphabet's capital expenditure in the second quarter of 2026 was $44.9 billion in a single quarter. 60% of that went to servers, primarily AI chips. 40% went to data centers and networking equipment. For the full year, Alphabet has now guided between $195 billion and $205 billion. That number is roughly double what the company spent last year. It is larger than the GDP of 150 countries. And the company's CFO told analysts it will go higher in 2027. Alphabet is not an outlier. It is the median. Amazon has projected $200 billion in 2026 capital expenditure. Microsoft is tracking toward $195 billion. Meta has guided between $115 billion and $135 billion. Combined, $725 billion in a single year from 4 companies. To put that in context, the entire Apollo space program, adjusted for inflation, cost roughly $257 billion. These 4 companies will spend nearly 3 times that amount this year on data centers, GPUs, and networking cable. And here is the part that matters. Alphabet's full-year capital expenditure guidance now exceeds its total operating cash flow from last year. The company literally cannot fund its infrastructure build-out from its own earnings. In June 2026, Alphabet executed an $84.75 billion equity raise specifically to pay for AI infrastructure. That is not a company comfortably investing in growth. That is a company borrowing from its shareholders to fund a bet that is not yet proven it generates more cash than it consumes. In about 3 minutes, we're going to show you the structural problem that makes this spending cycle different from every infrastructure build-out that came before it. It is not the size, it is the shape. Here is where the $725 billion actually goes. Step 1. The hyperscalers buy GPUs, primarily from NVIDIA. NVIDIA posted $215.9 billion in revenue for fiscal year 2026, a 65% increase. That revenue is almost entirely the hyperscalers' capital expenditure arriving at NVIDIA's cash register. Step 2. The hyperscalers use those GPUs to build cloud computing capacity. They sell that capacity to AI companies, startups building foundation models, enterprise clients deploying AI tools, and developers running inference workloads. Step 3. The AI companies, OpenAI, Anthropic, and hundreds of smaller startups use that cloud capacity. Their primary expense is compute. Their primary revenue source is venture capital. They spend venture capital on cloud computing. That spending shows up as revenue for the hyperscaler.
Step 4. That cloud revenue growth, 82% at Google Cloud this quarter, is cited as evidence that AI demand is real and growing, which justifies the next round of capital expenditure, which justifies the next GPU order, which becomes NVIDIA's next quarter of record revenue. The money is moving in a circle. Venture capital funds AI startups. AI startups spend on cloud compute. Cloud compute revenue justifies hyperscaler CapEx. Hyperscaler CapEx funds NVIDIA's revenue. NVIDIA's market cap justifies the entire AI valuation ecosystem. And the cycle continues.
What you're about to see next is the part of this story that no earnings call is designed to surface. Stay with it. The question no one on an earnings call is required to answer is, at what point does the money that enters this circle come out as profit for someone who is not inside it? Because right now, the only companies consistently generating cash from AI are the ones selling the infrastructure to build it, not the ones using it. Multiple enterprise surveys in 2025 and 2026 reported that 95% of corporate AI projects returned zero measurable value. 95%. The companies buying the cloud computing that justifies the data centers, that justify the GPU orders, that justify the entire capital expenditure cycle. 95% of them are getting nothing back.
There is a specific structural problem inside this spending cycle. It is not about whether AI works. It is about how long the things they are buying last. A GPU, the chip that powers every AI training run, every inference workload, every model deployment, has a useful economic life of approximately 2 to 3 years. After that, it is either obsolete or too slow to compete with the next generation. The data center that houses the GPU has a longer life, 20 to 25 years for the physical structure, but the servers inside it are refreshed every 3 to 5 years. The cooling systems, the networking equipment, the power infrastructure, all of it requires continuous reinvestment. So when Alphabet spends $44.9 billion in a single quarter on servers and data centers, roughly 60% of that spend, the servers, will need to be replaced within 36 months. The capital is consumed faster than the revenue it generates can pay it back.
And the financing does not match the asset life. Alphabet raised $84.75 billion in equity in June 2026. That equity dilutes existing shareholders permanently. The GPUs it funds will be economically obsolete by 2029. The dilution stays. The asset does not. The same mismatch exists across all 4 companies. Amazon, Meta, and Microsoft are all funding AI infrastructure through a combination of operating cash flow, debt issuance, and equity dilution. The assets they are acquiring have short useful lives. The financial obligations they are taking on do not. This is not a technology problem. It is a capital cycle problem. And capital cycles that fund short-lived assets with long-duration obligations have a name. They are called mismatches, and they resolve in one of 2 ways. Either the assets generate enough return fast enough to outrun the depreciation, or the obligations consume the balance sheet. I should be honest here. A year ago, I would have said the return was coming.
Cloud growth was accelerating, enterprise adoption was expanding, and the revenue trajectory looked like it would eventually justify the spend. Then, Alphabet posted negative free cash flow for the first time in 22 years. And I stopped assuming the trajectory was going to save the math.
The AI infrastructure build-out is not a technology question anymore. It is a financial engineering question. And financial engineering questions have financial engineering answers, not technology answers. Meta and Microsoft report earnings on July 30th. Amazon and Apple report the next day. If the pattern holds, record revenue, higher CapEx guidance, negative or declining free cash flow, this will be the first quarter in history where the four most profitable technology companies on Earth simultaneously spent more money than they generated. We'll be watching.